Did you know that if you sell real estate, you might actually have to pay tax on the capital gains of that real estate? But there are certain situations when you don't. If you want to know the difference, stick around and find out next. Hey friends, Ryan Reynolds here with Keller Williams Consultants Realty, your KW certified real estate planner. And today I want to talk about the two different types of real estate that exist through the eyes of the IRS. And to first start off, I am not a tax person or an IRS person. This is just the information I have gathered over the years and what I understand. So it could be a little bit wrong, but for the most part, it's probably going to be right. And if you have questions about your specific situation, you should definitely talk to a CPA or tax person. So with that all said, I want to talk quickly about the two types of real estate that exist in the eyes of the IRS. It's pretty simple. It's either the house you live in or the house you don't live in, or it could be property, or it could be any kind of thing. So in other words, you have a principal residence on one hand, and then on the other hand, you'd have a rental home or a vacation house or an Airbnb that you own, something like that. And those two types of property are treated completely different from an IRS perspective. So the first piece of real estate we're going to talk about today is the one you live in. That is called your primary residence. And the government's actually pretty nice to you these days. They give you an exclusion as a single person of $250,000 or as a married person of $500,000 of gain that you can exclude about every 2 years. So the way the rule works that I understand is that if you've lived in a house for 2 of the past 5 years and you've used it as your primary residence, then you can essentially sell that for $250,000 or $500,000 if you're married, more than you bought it for, and then not have to pay any tax on the gain. That's called the 121 exclusion in real estate, and it replaced what used to be something where people thought they used to have to trade up, and then they had a one-time exemption. That old rule where you would buy a house that's more expensive than your current house and not have to pay any tax on the gain, and you kept doing that over the course of your life, and then you would sell it one time, you get a big exclusion, that is gone and has been replaced by the 121 exclusion, which is every 2 years you can sell a principal residence and take $250,000 or $500,000 for a married couple and exclude that gain. So that's the principal residence rule. The second rule applies to any other real estate that you own that could be either investment real estate or vacation houses or anything else that's not your primary residence. And in those cases, what happens is that you will pay tax on the gain, probably a long-term capital gain, of anything you have over what you purchased it for. So in this case, if you buy a house for $100,000, rent it out for 10 years, and you sell it for $500,000, you'll have about a $400,000 gain if you don't worry about the depreciation and the increases in basis. But let's just, for simple purposes, say you had a $400,000 gain, you're going to pay tax on that $400,000. Now, you're probably thinking, is there a way to avoid that? I want to buy another investment property. I don't want to pay all this tax on that. Would the government give me a chance? The answer is yes. It's called a 1031 exchange, and we talked about that in some of my other videos. So those are the two types of real estate that exist under the IRS's eyes: primary residences and investment properties. If you have questions about your situation with real estate, feel free to reach out. I can help you understand a little bit more about which one of those probably apply. If there are specific situations, though, you want to talk to your tax advisor. That's all I have for you today. My name is Ryan Reynolds. I'm a real estate agent with Keller Williams Consultants Realty and your certified real estate planner. Have a great day, and we'll see you next time.